Started without drama, no flashing lights, no courtroom sketch, no angry press release. Just a number that didn't behave the way numbers are supposed to. Before we continue, please hit the like button, subscribe to the channel, and turn on the notification bell for updates. $2.3 million. That figure didn't arrive all at once. It didn't slam into an account like a breaking news alert. It accumulated quietly, transaction by transaction, month by month, until it reached a point where someone, somewhere inside a financial institution whose entire business model depends on patterns making sense, stopped and said, wait. And that's the moment this story really begins. Because when a global financial institution pauses, not publicly, not theatrically, but internally, something has already gone wrong in a way that can't be fixed with a phone call or a clarification email. Systems have flagged something, compliance has been notified, a review has begun, and those reviews, almost by definition, do not care about celebrity, intention, or narrative. They care about consistency, about authorization, about whether what was represented matches what actually happened. Here's the unsettling contradiction at the center of this story. In public, financial scandal is usually loud. It arrives wrapped in spectacle. Mugshots, sound bites, leaks, accusations shouted before evidence is ever read. This didn't. This arrived quietly, procedurally, through filings, internal assessments, and eventually, according to court records, a lawsuit initiated not by a tabloid, not by a political adversary, but by American Express itself. That alone should make you pause, because American Express does not rush to court. It is not a company that makes accusations casually, and it is certainly not a company that files lawsuits over misunderstandings that can be resolved behind closed doors. Its entire ecosystem is built on trust, discretion, and negotiated resolution. When it moves from internal compliance to formal legal action, it usually means something has already failed multiple times. So why now? Why this figure? And why a lawsuit? Those are the questions we're going to sit with today. Not rush past, not simplify, not shout over, because this story isn't really about a credit card. And it's not even, at its core, about money. It's about records, about what happens when private financial behavior intersects with institutional thresholds that do not bend for reputation, about what it means when a system designed to tolerate ambiguity decides that ambiguity has gone too far, and about what happens next once the paper trail exists. Now, before we go any further, let's be clear about something, because clarity matters here. A lawsuit is not a conviction, an allegation is not proof, and public perception is not legal reality. But a lawsuit is also not a rumor. It is a formal claim made under penalty of law. It is a statement that a company believes it has sufficient grounds to put its position on the record, knowing it will be scrutinized, challenged, and preserved. And once that happens, the story changes permanently, because court filings don't fade. They don't get re-edited. They don't disappear when attention shifts. They sit there, waiting, available to anyone willing to read them carefully. And that's what we're going to do. Slowly, carefully, with restraint. The number being discussed, $2.3 million, has already started to circulate online, often detached from context. People hear it and assume excess, or extravagance, or scandal in the cartoonish sense. But numbers like this are rarely about a single purchase or a single decision. They are about accumulation, about categorization, about how expenses are represented, coded, justified, and approved over time. Which raises the first uncomfortable question: at what point does spending stop being within expectation and start becoming something else? For ordinary cardholders, that line is low. Credit limits are rigid. Spending triggers immediate responses: a declined transaction, a warning text, a temporary freeze. But for high-limit accounts, especially those tied to complex personal and professional structures, the line is higher, much higher. These accounts are designed to accommodate variability. They expect irregular spending. They tolerate fluctuations, which means that when one of these accounts triggers concern, it's usually not because of one large purchase. It's because of a pattern. And patterns are where intent starts to matter. This is where many stories like this lose discipline. They jump straight to moral conclusions. They reduce complex financial mechanics to character judgments. We're not going to do that. Instead, we're going to ask a more precise question. What does a company like American Express actually look for when it decides something may constitute fraud or misrepresentation or misuse? The answer is not what most people think. Fraud, in the civil sense, is not primarily about stealing. It's about representation, about whether the account holder or authorized user presented information in a way that caused the company to extend credit under assumptions that were materially inaccurate. That's a narrow concept, and a powerful one, because you can pay every bill on time and still be accused of fraud. You can believe you are entitled to make a charge and still face scrutiny. You can even have authorization and still cross a line. That's not intuitive, but it's real. And according to the lawsuit we're examining, that distinction is central. Now, you may be asking yourself something reasonable at this point. Why would this escalate to court at all? Why wouldn't a company simply close the account, negotiate repayment, or quietly move on? That's the question that hangs over this entire case. Because lawsuits are expensive, they are slow, and they invite attention, exactly the thing institutions usually try to avoid. Which suggests that, at least from the perspective of the filer, something about this situation could not be resolved through normal channels, either because of disagreement, or because of documentation, or because of a principle that, once triggered, demanded escalation. We don't know yet which of those applies, but we will. And when we get there, the story starts to narrow. The ambiguity tightens. The room for interpretation shrinks. Still, it's important to sit in this early uncertainty for a moment, because this is where the audience often rushes ahead of the facts. They fill in gaps with assumptions. They import narratives that feel emotionally satisfying but analytically sloppy. This story doesn't reward that approach. It rewards patience. It rewards attention to boring details, to timelines, to language choices in legal documents, to what is emphasized and what is conspicuously left out. For example, the lawsuit does not allege something dramatic in tone. It doesn't read like an expose. It reads like a calculation. That alone tells you something. There is no performative outrage in legal filings like this. There is no incentive to exaggerate. Every word is chosen because it must survive scrutiny. Every claim must be defensible, which is why one sentence, one particular phrase buried deep in the filing, changes how the entire situation is interpreted. We're not there yet, but we will be. Before we get into the mechanics of the case, the number itself deserves one more moment of reflection. $2.3 million, not spent in a single year, not charged in a single burst, but allegedly accumulated through a series of transactions that, when viewed individually, may not have raised alarms. This is how many financial cases unfold. No one transaction looks outrageous. No single charge screams abuse. But together, they tell a story that is difficult to unsee once you know what to look for. And this is where systems outperform people. A human might rationalize. A system just counts. It notices frequency. It notices categorization drift. It notices when spending that was once aligned with one explanation begins to resemble something else entirely. That's when internal flags appear. Not accusations, flags. A flag does not mean wrongdoing. It means uncertainty. It means a question has been raised that requires review. And once a review begins, a cascade follows. Statements are pulled. Authorizations are examined. Communications are logged. Explanations are requested. Sometimes, those explanations satisfy the review. The flag is cleared. The case is closed. Other times, they don't. And when they don't, the process escalates, step by step, committee by committee, until a decision is made that the issue can no longer remain internal. That's the point we're circling, not the spending itself. But the moment when someone decided this could not be handled quietly anymore. Ask yourself this: what would have to happen for a company whose brand is built on discretion to choose visibility instead? What would make the risk of public attention preferable to the risk of precedent? That's not a rhetorical question. It's the spine of this story, because whatever the answer is, it doesn't live in headlines. It lives in the process, in the thresholds, in the internal determinations that almost never become public, except when they do. And once they do, they create a record that no amount of narrative control can erase. As we move forward, we're going to unpack this story the way institutions do. Not emotionally, not politically, but structurally. We're going to look at how credit works at this level, what authorization actually means, how spending categories become liabilities, and why intent, in the legal sense, is often inferred long after the last charge is made. And at the center of it all, a lawsuit that did not need to exist, unless something made it necessary. But what that something is, that's where this stops being theoretical. Because according to the filing, this wasn't about one misunderstanding, it was about a pattern. And once that pattern was identified, everything else began to fall into place. But what came next would change how this entire situation is understood, and no one saw it coming. What came next wasn't dramatic, it wasn't even obvious. It was technical, and that's what made it dangerous. Because the moment a credit card stops being just a card, it enters a world that most people never see, one governed less by intuition and more by thresholds, less by trust, more by tolerances, less by who you are, more by what the system can no longer explain away. Here's the question that rarely gets asked out loud. When does convenience quietly turn into exposure? For most cardholders, the answer is simple. You hit a limit. You get a text, your transaction declines. End of story. But that's not how high-limit accounts work, especially not the kind designed for individuals whose spending doesn't follow neat monthly patterns. These accounts are built with elasticity baked in. They expect uneven behavior. They allow for travel spikes, unusual vendor charges, expenses that don't fit grocery store categories, which means the guardrails are further apart, much further. So when something finally presses against them, it's not because of a single extravagant charge. It's because the system has begun to ask questions it can't resolve on its own. This is the part of the story where people often assume a human sits down, sees a number, and reacts emotionally. That's not what happens. At this level, no one is shocked by spending. Shock is not a metric. Deviation is. The system doesn't care if a charge feels justified. It cares whether it aligns with what was represented when credit was extended, whether the categories match prior explanations, whether the velocity of spending makes sense given historical behavior, and whether over time the story the account is telling still holds together. Because every account tells a story. At first, it's simple. A person, a card, a pattern, then layers get added. Authorized users, expense classifications, business justifications, reimbursements, timing. Each layer adds complexity, and each one creates new points of failure. And here's the contradiction that sits at the center of this case. The more flexible an account is designed to be, the more precise the scrutiny becomes when something feels off. Flexibility does not mean blindness. It means delayed judgment. So let's slow this down, because understanding how a card stops being just a card requires understanding how oversight actually works when spending crosses certain invisible lines. Inside institutions like American Express, there is a quiet hierarchy of attention. At the bottom, automated monitoring. Above that, algorithmic flags. Above that, human review. Above that, compliance escalation. Most accounts never climb past the first rung. Some trigger a flag, get reviewed, and settle back into normalcy. But a small percentage, very small, continue upward. And once they do, the question is no longer, is this unusual? It becomes, is this explainable? That distinction matters, because unusual can be tolerated. Unexplainable cannot. Now, here's where things get uncomfortable. Unexplainable does not mean illegal. It does not even mean dishonest. It means the documentation no longer reconciles cleanly with the activity. And when that happens, institutions have an obligation, not just a preference, to act. That obligation doesn't come from optics. It comes from regulation, from risk exposure, from the knowledge that failing to address anomalies can create precedent. Precedent is the enemy here. If one account is allowed to drift beyond its stated parameters without consequence, others will follow. Systems weaken, standards erode. So the response becomes less about the individual account and more about preserving the integrity of the framework itself. This is why companies like American Express document everything. Every call, every explanation, every adjustment. Because when an account finally crosses into formal dispute, the question is no longer what happened. It's what was said when concerns were raised, and whether those responses resolved the concern or deepened it. Let me ask you something. Have you ever looked back at a bank statement months later and thought, I don't even remember this charge? Now imagine that feeling, but scaled up, formalized, and placed under legal scrutiny. Because at this level, memory doesn't matter. Records do. And records are unforgiving. In this case, according to the lawsuit, the issue wasn't one rogue charge, it wasn't one disputed expense. It was a pattern that emerged only when transactions were viewed together. This is where the story starts to narrow, because patterns don't accuse, they suggest. They suggest that spending once categorized one way may have gradually shifted into another, that authorizations granted for one purpose may have been stretched into adjacent territory, that explanations that once satisfied no longer aligned with the data. And here's the thing people often misunderstand. You don't need malicious intent for a pattern to become problematic. You just need repetition. Enough repetition, and what once looked like an exception begins to look like a rule. That's when systems stop giving the benefit of the doubt. This is also where the difference between authorization and usage becomes critical. Because authorization is not a blank check. It is contextual. It is bounded by purpose, by representation, by time. You can be authorized to use a card and still use it in a way that violates the conditions under which that authorization was granted. That sounds abstract, but it's not. Imagine being given a company card for travel expenses and slowly using it for other costs that feel related. At first, no one notices. Then someone does. Then questions are asked. Now scale that scenario up. Scale it to 7 figures. Scale it across months. Scale it across categories that don't neatly overlap. At some point, the question stops being whether the spending was convenient or even reasonable. It becomes whether the institution was misled about what it was extending credit for in the first place. That's where legal language enters, not emotionally, not accusatorily, but structurally. Words like representation, reliance, material difference. Those words appear not because someone wants a headline, but because they are the only tools the law has to describe a breakdown between expectation and reality. And according to the filing, that breakdown reached a point where it could no longer be addressed quietly, which brings us back to the escalation. Because internal reviews do not become lawsuits overnight. There are steps. First, an inquiry. Then, clarification requests. Then, documentation. Then, internal discussion. At each stage, there is an opportunity for the matter to resolve, to be explained, to be corrected, to be closed. So when a company ultimately files suit, it's worth asking not just what they allege, but what failed to satisfy them along the way. That's the missing space we're circling. Not the spending itself, but the response to the scrutiny. Was there disagreement about categorization? About responsibility? About who authorized what and when? Was there silence where explanation was expected, or explanation that created more questions? We don't have all of that yet, but we do know this. The lawsuit exists, which means whatever was offered or not offered did not resolve the issue internally. And that tells us something important. It tells us this wasn't impulsive, it wasn't reactive, it wasn't rushed, it was the end of a process that began the moment a number stopped behaving the way it should. And once that process ended, the account was no longer just an account. It became a case. But here's where the story takes a turn. Because the lawsuit, as filed, does not hinge on outrage. It hinges on something far colder. Timing. The timing of charges. The timing of classifications. The timing of changes in behavior. And most critically, the timing of when concerns were raised. And what happened after? Or was it something else entirely? That's the question that starts to press in once you stop looking at totals and start looking at sequences. Because money doesn't just move. It moves in patterns. And those patterns, when laid out across time, tend to reveal more than any single statement ever could. Here's what's important to understand before we go any further. Credit card oversight at this level doesn't happen in real time. It happens retrospectively. The system allows behavior to unfold, to reveal itself, to either settle into something coherent or drift. Drift is the key word. Drift doesn't announce itself. It's subtle. It happens when spending that once fit comfortably inside a given explanation begins to stretch that explanation just enough to require footnotes, then disclaimers, then rationalizations, and eventually, questions. In this case, according to the filing, the earliest charges weren't alarming on their own. They didn't trigger immediate freezes or confrontations. They were absorbed into the expected variability of a high-limit account, which is exactly why they matter, because systems don't react to noise. They react to deviation from baseline. And baseline, once established, becomes the reference point against which everything else is measured. Think about that for a moment. The system isn't comparing these charges to some abstract idea of excess. It's comparing them to the account's own history, to its own internal logic. So when that logic, they account for it. But they also look for drift. Drift happens when spending gradually shifts away from its original explanation without that shift being acknowledged. At first, the difference is small. A few charges here and there, nothing that forces confrontation. But when those charges repeat, the system begins to ask whether the category itself is still valid. And once that question is asked, everything that follows is examined through a different lens. Now, let's slow this down even further. $2.3 million didn't appear because someone sat down and decided to spend that amount. It appeared because charges accumulated under assumptions that were never formally revisited. That's not an accusation. It's a structural observation. Institutions don't expect perfection. They expect updates. They expect that when spending patterns change materially, the explanations change with them. And when that doesn't happen, the gap between representation and reality widens. This is where the lawsuit draws its power, not from shock, from specificity. The total is not just a number, it's a boundary, a point at which the institution determined that the accumulation itself had become meaningful. Below that boundary, ambiguity was tolerable. Above it, it wasn't, which suggests something else. The institution didn't react at the first sign of deviation. It waited. It observed. It allowed the story to unfold. Only when the accumulation crossed an internal threshold did it decide the issue could no longer be resolved quietly. That's a critical point, and one that often gets lost in public discussion. This wasn't impulsive. It was deliberative, and deliberation leaves a trail. Every internal review generates notes. Every escalation generates memos. Every unresolved question generates follow-up. Those records matter more than any headline ever could. Because when a lawsuit is filed, those records don't disappear. They become discoverable, which raises the stakes considerably. Now, here's where the emotional temperature of the story begins to rise, not because of outrage, but because of implication. If the dispute were purely about amount, it could be negotiated. If it were purely about repayment, it could be settled. But when it's about representation, about whether the institution was induced to extend credit under assumptions it would not have accepted had it known the full picture, the terrain changes. That's when legal language hardens. That's when totals stop being flexible. And that's when $2.3 million stops being a sum and starts being a symbol of how far the account traveled from its original baseline, a symbol of how long the institution allowed that travel to continue, and a symbol of why, eventually, patience ran out. Let me ask you something that's uncomfortable but necessary. If this total had been $200,000, would we be here? Probably not. If it had been 500,000, still unlikely, which means the number itself mattered, but not because of its size alone, because of what it represented about duration, repetition, and unresolved classification. And that's where the story tightens again, because the lawsuit doesn't just list a total, it anchors that total to time. It suggests that the accumulation occurred during a period where oversight should have caught up, but didn't. And that raises another question. Why didn't it? Was the system slow? Or was the behavior subtle enough to evade immediate detection? Or, and this is where things get delicate, were explanations offered that temporarily satisfied the review, only to break down later? We don't have all of that yet, but the fact that the institution ultimately chose litigation suggests that whatever explanations existed did not hold up under sustained scrutiny. And that's where the number becomes more than arithmetic. It becomes a narrative. A narrative the institution believes it can defend in court. A narrative that says, this wasn't a misunderstanding frozen in time. It was an accumulation that continued even after questions were raised. That's the implication. And if that's true, if the accumulation persisted past the point of inquiry, then the meaning of the total changes again. It stops being retrospective. It becomes contemporaneous. And that's dangerous territory, because courts care deeply about what happens after concerns are raised. They care about response. They care about adjustment. They care about whether behavior changed once scrutiny began. And according to the structure of the complaint, that issue is central. Which brings us to the next turn in the story. Because before we can talk about intent or defense or outcome, we have to understand what the institution believes it needed to prove and what it didn't. What thresholds had to be crossed for this to move from internal review to formal allegation? And why those thresholds are far narrower than most people realize. That's where we're going next. Because once we understand what American Express actually has to demonstrate in a case like this, the story stops being speculative and starts being procedural. And procedures, once triggered, don't care how the story sounds. They care whether it holds. But that's a conversation that belongs in the next chapter. So now we have a number, not as a headline, as a boundary. And once a boundary is crossed, the question stops being how it feels and starts being what the law requires. Here's the part most people never hear and almost no one understands until they're inside it. In a civil case like this, American Express does not have to prove what you think it has to prove. It doesn't have to prove criminal intent. It doesn't have to prove theft in the dramatic sense. It doesn't even have to prove that every disputed charge was illegitimate. That surprises people. Because we're conditioned to think of fraud as something explosive, as something that requires a smoking gun, a confession, a clear villain. Civil fraud doesn't work that way. It works quietly, narrowly, structurally. And that's where this case becomes far more precise and far more unsettling than the headlines suggest. Let's strip this down to its core. For a civil fraud claim to survive, an institution like American Express generally needs to establish a few specific elements. Not many. Just enough that a representation was made, that the institution relied on that representation, that the representation was materially inaccurate or misleading, and that the reliance resulted in financial exposure. Notice what's missing. Motive, emotion, character. None of that is required. The law doesn't ask whether someone meant to deceive in the way we imagine deception. It asks whether the institution was led to extend credit under assumptions that did not match reality. That's it. And once you understand that, the entire case reframes itself. This isn't about proving someone set out to commit fraud. It's about proving that the conditions under which credit was extended no longer reflected how that credit was actually used, and that the institution would not have extended it on the same terms had it known. That's a colder argument, a tighter one, and one that's much easier to make on paper than people realize. Because representation doesn't have to be a speech. It can be an application, a designation, a category, a repeated pattern that implies continuity. Silence can be a representation too. If spending continues under an existing framework, the framework itself becomes the representation. And when that framework breaks, the question becomes whether the institution was entitled to rely on it, as long as it did. This is where people often say, but surely there were safeguards. There were. That's the point. Safeguards don't prevent every problem. They create records when problems persist. And those records are what lawsuits are built on. Let me slow this down again, because this is where the narrative usually jumps too fast. American Express did not wake up one day and decide to accuse someone of fraud. It monitored, it flagged, it reviewed. And only when it concluded that the discrepancy between representation and usage was material did it escalate. Material is a legal word. It doesn't mean shocking. It means consequential. Would this information have mattered at the time credit was extended? If the answer is yes, the threshold is met. And according to the lawsuit, that's the position being taken. Not that spending occurred, but that spending occurred under a set of assumptions that no longer applied. That's a subtle argument, but a powerful one, because it shifts the burden. The institution doesn't have to prove every charge was improper. It only has to show that the overall pattern no longer fit the story under which the account was allowed to function. And once that's established, the total matters less than the divergence. Which brings us back to the $2.3 million. That number isn't there to shock. It's there to demonstrate scale. Scale matters because it speaks to duration, to repetition, to the opportunity for correction. Courts pay close attention to whether alleged misrepresentation was isolated or ongoing. Ongoing issues are harder to dismiss as mistakes, especially when systems flagged them and inquiries followed. This is where the phrase, buried in the filing, becomes important. Reliance? The institution claims it relied on certain representations when allowing continued use of the account. Reliance is not blind trust. It's conditional acceptance. It means the institution continued to extend credit because it believed the underlying assumptions were still valid. And if those assumptions weren't valid, if they had materially changed without disclosure, that reliance becomes the hinge of the case. Here's the uncomfortable implication. If American Express can show that it asked questions, received responses, and continued to extend credit based on those responses, then the issue is no longer passive. It becomes interactive, and interactive processes generate responsibility. That's where things tighten, because once questions are asked, silence is meaningful. Once explanations are offered, their accuracy matters. Once adjustments are requested, compliance, or lack of it, becomes part of the record. We don't yet know every detail of those interactions, but the fact that litigation followed suggests the institution believes it can demonstrate that reliance persisted longer than it should have, and that it did so based on information it now disputes. This is why the lawsuit doesn't read like outrage. It reads like a ledger, because ledgers don't moralize, they reconcile, and when reconciliation fails, they escalate. Another misconception worth clearing up: people assume institutions prefer to avoid lawsuits because they're bad for business. Sometimes that's true, but sometimes lawsuits are the only way to protect business. Because if an institution becomes aware that it extended credit under misapprehensions and fails to act, it exposes itself to regulatory risk. Regulators don't care about celebrity either. They care about consistency. Did the institution treat this account the same way it would treat any other account with similar deviations? If the answer is no, that becomes a problem. So litigation can be defensive as much as accusatory. It formalizes the institution's position, it documents its response, it demonstrates that it acted once thresholds were crossed, which suggests another reason this didn't stay quiet. It couldn't, not without creating precedent that would weaken the entire system. This is why the idea that they could have just closed the account is misleading. Closing an account doesn't resolve prior exposure. It doesn't address reliance. It doesn't create a legal record. Sometimes, the only way forward is through court. Now, let's talk about what American Express does not have to prove. It does not have to prove intent in the criminal sense. It does not have to prove that someone woke up one morning and decided to deceive. Intent, in civil cases, can be inferred from conduct, from continuation after inquiry, from repetition after warning, from patterns that persist despite opportunities to correct them. This is why the timeline we discussed earlier matters so much. If the accumulation occurred entirely before any scrutiny, that's one thing. If it continued after scrutiny began, that's another. Courts draw a bright line there. And according to the structure of the complaint, that line is central, which brings us to defense. Because of course there are defenses. Good faith misunderstanding, complex expense structures, delegation to advisors or staff, ambiguity in categorization. All of these are common and sometimes effective, but they all hinge on one thing: whether the institution was kept informed as conditions changed. Because good faith requires communication, and communication creates records. This is why silence is so dangerous in these cases. Not because it implies guilt, but because it removes ambiguity. If no update is provided, the institution continues to rely on outdated assumptions, and if that reliance leads to exposure, the responsibility shifts. This is the quiet logic of civil fraud. It's not about villains, it's about misalignment. And once misalignment reaches a certain scale, the law intervenes, not to punish, but to resolve, or at least to try. As we move forward, we're going to stop talking in abstractions, because the next turn in this story isn't about theory, it's about gray zones, about the narrow space between authorization and misuse, about how reasonable people can disagree, and how institutions decide which side of that disagreement they're willing to defend in court. Because the most dangerous territory in cases like this isn't the obvious excess. It's the gray area where lines weren't clearly redrawn as circumstances evolved. That's where most defenses live, and that's where most cases are won or lost. So the next chapter isn't about allegations, it's about boundaries, about what authorization actually means and when it quietly expires. And once we step into that territory, the story becomes much harder to simplify, because that's where intention, oversight, and assumption collide, and once they do, the outcome becomes far less predictable than anyone expects. But to understand that collision, we have to walk straight into the gray, and that's where we're headed next, because this is where things usually break, not in the obvious places, not in the extremes, but in the narrow space where permission and practice slowly drift apart. Authorization. It sounds solid, official, final, but it isn't. Authorization is conditional, contextual, time-bound, even when no expiration date is written on paper. And this is the part of the story where almost everyone, institutions included, gets uncomfortable, because authorization feels binary. You have it or you don't. In reality, it's closer to a living agreement, one that quietly depends on assumptions staying true. So let's sit with that. When an account is authorized, especially a high-limit account, it's authorized under a specific understanding. Not always spelled out in dramatic language, but embedded in categories, use cases, representations, prior behavior. Business expenses behave one way. Personal expenses behave another. Mixed use exists, but only within boundaries. Those boundaries are rarely tested all at once. They're tested incrementally. And that's why disputes like this don't begin with confrontation. They begin with confusion. Because from the account holder's perspective, nothing may feel different. Charges are going through. Statements are being paid. Life continues. From the institution's perspective, something else is happening. The story the account is telling has started to contradict itself. That's not a moral judgment. It's an accounting one. Here's a question worth asking, even if it makes us uneasy. When does authorization quietly expire, even if no one says it out loud? Because expiration doesn't always mean revocation. Sometimes it means the original conditions no longer apply. Imagine authorization as a bridge. It's built to support a certain kind of traffic. If the traffic changes, gets heavier, faster, differently distributed, the bridge doesn't collapse immediately. It strains. And strain shows up first in data. That's where American Express, according to the lawsuit, began to focus. Not on whether charges were technically allowed, but on whether they still fit within the framework under which the account was allowed to function. That distinction is everything, because allowed and appropriate are not the same thing in financial oversight. An authorized charge can still be problematic if it falls outside the scope of representation, and representation doesn't have to be spoken. It can be implied by consistency. This is where many people get tripped up. They assume that because something worked yesterday, it will work tomorrow. That authorization is a static permission. But institutions don't see it that way. They see authorization as a standing assumption, valid only so long as behavior aligns with it. Once behavior shifts materially, the assumption needs to be revisited. If it isn't, the authorization begins to hollow out, quietly. Now, according to the structure of the complaint, this is precisely the gray zone being examined. Not whether spending occurred, not whether the card was used, but whether the use remained within the scope of what the institution understood it was supporting. That's a subtle argument, and one that's easy to misinterpret as nitpicking. It isn't. It's foundational. Because credit is extended based on risk assessment, and risk assessment is built on expected use. If expected use changes without disclosure, the risk profile changes. And once the risk profile changes materially, the institution's tolerance evaporates. This is why the lawsuit doesn't focus on a single unauthorized swipe. It focuses on patterns that allegedly extended beyond their original justification. Which brings us to delegation. Delegation is one of the most common and most misunderstood defenses in cases like this. People say, I didn't make those charges personally, or someone else handled that. And sometimes that's true, but delegation doesn't dissolve responsibility. It redistributes it. If an account holder delegates use to staff, advisors, or authorized users, the institution still expects oversight, not micromanagement. Oversight. That means reviewing statements, monitoring categories, responding to anomalies. And when anomalies persist, the expectation is not that delegation excuses them, but that delegation triggers correction. This is another place where authorization quietly erodes, because delegation is itself authorized under assumptions. Assumptions about purpose, scope, and control. If delegated use expands beyond those assumptions, the authorization no longer means what it once did. Again, no drama, just drift. Now, let's address the hardest part of this chapter, the part where reasonable people can disagree. Because gray zones exist for a reason. Expenses don't always fall cleanly into categories. Professional and personal lives overlap. Public roles blur private boundaries. Institutions know this. They build flexibility into their systems. But flexibility has limits. And according to the complaint, the issue here is not that overlap existed, but that overlap allegedly became dominant without reclassification. That's where the allegation sharpens. Not that mixed use occurred, but that the dominant character of the spending changed without the framework changing with it. This is where institutions start to ask uncomfortable questions. Should this account still be treated the same way? Should these charges still be categorized the same way? Should the underlying assumptions be revisited? And if those questions aren't addressed proactively, the institution addresses them retroactively, through review, and sometimes through litigation. This is also where tone matters. The lawsuit does not accuse recklessness, it doesn't accuse extravagance, it accuses misalignment between what was represented and what was done. That's why this case doesn't live comfortably in sound bites. It requires attention, because the difference between authorized use and misuse is not a feeling, it's a function of context. Context that changes over time. Which brings us to the most uncomfortable implication of all. Authorization can be technically valid and practically void at the same time. That sounds contradictory, but it's how systems work. A door can remain unlocked while access is no longer appropriate. And if someone continues to walk through that door without reassessing why it was unlocked in the first place, the issue isn't trespass, it's assumption. This is why courts spend so much time on communication. Who knew what, when they knew it, what they did or didn't do with that knowledge. If an institution raises concerns and behavior doesn't change, authorization weakens. If explanations are offered but don't resolve discrepancies, authorization weakens further. Eventually, the original permission no longer carries the weight it once did. And at that point, continued use becomes something else, not necessarily criminal, but contestable. That's the word that matters here. Contestable. And once use becomes contestable, the institution has a choice. Absorb the risk or formalize the dispute. American Express, according to the filing, chose the latter, which tells us something about how far this drift went. Because institutions are very good at tolerating gray, they only stop tolerating it when it becomes structurally unsustainable. Now, let's pause and ask a question that most people don't want to ask. Could this have been prevented? Possibly. Through reclassification, through updated disclosures, through renegotiation of terms. Those pathways exist for a reason, but they require recognition that the underlying story has changed. And recognition is often the hardest step because acknowledging change feels like admitting something was wrong before. Sometimes nothing was wrong. It just evolved. But institutions don't assume evolution without documentation. They require it, and when it doesn't appear, the system defaults to its most conservative interpretation. That's not personal, it's institutional survival. As we move toward the next chapter, the focus narrows again, because the gray zone only matters until timing enters the picture. Once we align spending behavior with specific moments, moments when questions were asked, moments when patterns shifted, the story gains edges. Edges courts can work with, edges defenses have to confront. The next chapter is where those edges appear. Because when we stop looking at authorization in the abstract and start placing it on a timeline, the ambiguity tightens. And timing, more than anything else, determines whether a case like this dissolves quietly or hardens into something much harder to unwind. That's where we're headed. And once we get there, the question of why now becomes impossible to ignore. Why didn't it happen sooner? That's the question that starts to hover once you line everything up. Not emotionally, chronologically, because when people hear about a lawsuit like this, an alleged dispute of this scale, they assume there must have been a single triggering moment, a breaking point, a day when everything suddenly collapsed. But the filings don't describe a collapse, they describe a delay. And delays in financial oversight are rarely accidental. Timing is not just a detail here, it's the architecture of the case. Because if you want to understand why something escalated to litigation, you don't start by asking what happened. You start by asking when it happened and when it didn't. Let's sit with that. According to the structure of the allegations, the spending that ultimately formed the disputed total did not peak and immediately provoke action. It unfolded. It persisted. It was allowed to continue for a period of time that, in hindsight, feels almost too long. That's not negligence. It's process. Institutions like American Express don't react to early signals the way individuals do. They don't assume the worst. They assume variance. A spike might be travel. A cluster might be seasonal. A category shift might be temporary. Early intervention can create more problems than it solves, especially with complex accounts. So, the system waits. It watches, it collects. That waiting period is what makes timing so important, because once you know when scrutiny began, everything that follows is interpreted differently. Spending before scrutiny is one thing, spending after scrutiny is another. And that's the hinge. According to the framework implied by the complaint, there was a point at which the account moved from passive monitoring into active review. That doesn't mean the card stopped working. It means the account entered a different internal category, quietly. No alerts to the cardholder that say you're under review. No dramatic warnings. Just a change in how the data is being read. This is where public narratives often go wrong. They imagine review as confrontation. In reality, review is observation. The system wants to see what happens next. Does behavior normalize? Does it stabilize? Does it revert? Or does it continue? Continuation is what changes everything, because continuation after scrutiny suggests something different than continuation before it. It suggests either unawareness or disregard. And institutions don't need to decide which one applies. They just need to document that continuation occurred. That's why timing shows up so prominently once you know to look for it. The lawsuit does not center on the moment the total reached $2.3 million. That moment is almost irrelevant. What matters is what the spending looked like after internal concern had already been raised. Did categories adjust? Did velocity slow? Did explanations align more closely with behavior? Or did the pattern persist? This is the uncomfortable part of the story because it's where intention begins to be inferred, not from motive, but from response. Courts care deeply about what happens after questions are asked. If you continue doing the same thing after someone flags it as a concern, your behavior is no longer neutral. It becomes contextualized. That doesn't mean malicious, but it does mean meaningful. This is why institutions document outreach, calls, emails, requests for clarification. Each one is a timestamp, a marker that says, at this moment, uncertainty existed. And from that moment on, the burden subtly shifts. Before that, the institution is responsible for monitoring. After that, the account holder is responsible for responding in a way that resolves the uncertainty. If that resolution doesn't happen, if explanations don't change outcomes, then the timing starts to speak for itself. And timing, in cases like this, can be louder than numbers. Now, here's where the story becomes particularly delicate, because we don't know publicly every detail of those interactions. We don't know exactly what was said, how it was framed, or how it was received. But the existence of litigation implies that, from the institution's perspective, those interactions did not resolve the underlying concern. That's a strong inference, but a fair one. Institutions don't escalate to court while conversations are still productive, which means the period after scrutiny began is likely where the case is anchored, not the beginning, not the peak, the middle. That's where courts look when deciding whether a dispute is about misunderstanding or misrepresentation. Now, consider the emotional contradiction this creates. From the outside, continued spending can look like confidence, like business as usual. From the inside, it can look like indifference. And institutions don't interpret indifference generously. They interpret it conservatively, which means that every transaction after a certain point carries more weight than the ones before. It's not fair in a moral sense, but it's standard in a procedural one. This is why timing transforms the narrative, because once scrutiny begins, the system is no longer asking what is happening, it's asking what will happen next. And that question has only two acceptable answers: correction or continuation. According to the structure of the complaint, continuation is what occurred, and that's why the lawsuit doesn't feel reactive. It feels inevitable, because once continuation is documented, the institution's options narrow. It can absorb the risk, knowing it has identified a potential misalignment and chosen not to act, or it can formalize the dispute. Formalization is safer. It protects the institution from accusations of selective enforcement. It creates a record of response. It demonstrates that thresholds once crossed are treated consistently. This is why now is the wrong question. The right question is, why not earlier? And the answer is almost always the same. Because earlier, the system didn't know what it was seeing yet. Earlier, the pattern hadn't settled. Earlier, there was still plausible ambiguity. But ambiguity has a half-life. The next layer of the story is where defense begins and where ambiguity becomes its own battlefield. Because for every claim in the complaint, there is a potential counter-narrative, one that doesn't rely on dramatic denials or moral proclamations, one that relies on context, nuance, and the interpretation of data. Civil defense in financial disputes often looks less like courtroom theatrics and more like meticulous reconstruction, a transaction-by-transaction review, an explanation for each classification, a rationale for every anomaly, and sometimes a broader argument about authority, delegation, and expectation. Let's pause here. Delegation is deceptively simple in theory, but profoundly complex in practice. When an account holder delegates responsibility, whether to staff, advisors, or authorized users, they create a chain of accountability. That chain is visible to the institution through statements, authorizations, and response protocols. And if an unexpected pattern emerges, the question is, who bore ultimate responsibility? In most civil cases, responsibility cannot be outsourced entirely. Delegation does not erase accountability, it redistributes it, which is why defenses that hinge solely on delegation often falter unless supported by clear documentation showing oversight and control. Now consider good faith. Good faith is a common defense, and it is legitimate. It asserts that any discrepancies or patterns that appear outside expectations were unintentional, honest errors, or the result of complexity in categorization. But good faith is evaluated against what the institution reasonably relied upon. In other words, even a well-intentioned account holder may find themselves contesting claims if the institution demonstrates reliance on representations that ultimately did not align with observed behavior. Here's where patterns start to matter more than any individual transaction. Patterns suggest continuity. Continuity implies awareness, and awareness, even if unintentional, can influence liability. One-off charges can be explained, but when the same types of charges recur, especially after internal inquiries, they create a cumulative effect that undermines simple defenses. Then there is the issue of timing, which we've touched on before, but bears repeating here. Timing is crucial because it can establish whether discrepancies were ongoing after concerns were raised. Charges made prior to inquiry may fall into the realm of historical variance. Charges made after may be interpreted as continuation despite knowledge of scrutiny. And in civil proceedings, continuation after inquiry is significant. It becomes evidence of persistent misalignment between representation and actual conduct. All of this is where categorization comes back into play. Classification of charges, whether for business, travel, services, or personal use, doesn't just help the institution understand patterns. It establishes the framework against which alleged misrepresentation is measured. Misclassification, or the appearance thereof, strengthens the institution's argument that the account's reported activity did not reflect the original terms of authorization. Defense strategies often hinge on the argument that categories were ambiguous or flexible, that a charge that seems out of place in hindsight was justifiable at the time, that the account holder acted under reasonable assumptions. These arguments are valid, but their success depends on the quality of documentation and the persuasiveness of sequence. In other words, they require reconstructing the timeline, showing proactive communication, and proving that any discrepancies were addressed or excusable. Here's the tension. From the institution's perspective, documentation is king. Records of inquiries, responses, explanations, and adjustments create a chronological backbone. From the account holder's perspective, patterns may feel logical, categories may seem consistent, and actions may appear justified. But civil courts often privilege documentation over intention. The narrative becomes a function of evidence, not perception. This brings us to another critical point: silence. Silence can be interpreted in multiple ways. It can reflect compliance, unawareness, or inadvertent oversight. But once an institution has raised concerns, continued silence, or failure to resolve discrepancies can tilt interpretation against the account holder. Timing, persistence, and documentation combine to transform neutral behavior into contestable action. Now, consider materiality in the defense context. Materiality is not about size alone, it's about significance. A charge that seems trivial in isolation can become material when aggregated, or when it reveals divergence from expectations. Defense teams must confront this carefully. They cannot argue that large charges were immaterial simply because they feel justified. They must show alignment with the original representations and demonstrate that any deviation was rectified or excused within the expected framework. Furthermore, High-profile accounts add another layer of complexity. Visibility doesn't change the law, but it does intensify scrutiny. Institutions often anticipate public attention and are meticulous in preserving defensibility. This increases the stakes for defense strategies because any misstep or incomplete explanation is magnified. The interplay of pattern, timing, classification, and documentation creates a landscape where small misalignments can become significant. A transaction might seem negligible, but repeated over time, after scrutiny begins, it contributes to an accumulation that can justify litigation. The narrative is not about extravagance, it's about whether the account's conduct remained consistent with its original representations under the watchful eyes of the institution. Finally, we must consider the strategic implications of escalation. The institution's choice to formalize the dispute is not a reflection of character or intent. It is a procedural necessity once thresholds are crossed. Litigation is the endpoint of a carefully documented chain. Defense must navigate that chain, reconstruct it, and demonstrate alignment, oversight, or excusable divergence. Every document, every timing reference, every categorization becomes central. And here is the central challenge for the defense, showing that deviation was not meaningful enough to alter the institution's reliance, that the accumulation was acceptable under the terms of authorization, and that responses to inquiries were adequate. Every defense strategy hinges on this triangulation of pattern, communication, and interpretation. But even if a strong defense exists, the filing itself has already set the stage. The allegation of misalignment, the documentation of inquiry and continuation, the quantification of the total, and the timing all create a framework the court must take seriously. Which brings us to the final tension of this chapter. Defense is possible. Mitigation exists. But once escalation has occurred, the narrative is no longer about potential. It's about formalized positions, about records, about thresholds crossed, and procedural obligations triggered. And the next chapter is where we move deeper into those records, into the communications, the memos, the footnotes, and the timestamps. Because that's where the story begins to acquire texture, where abstract patterns become tangible evidence, where the interplay of pattern, timing, and authorization starts to crystallize in a way that makes the stakes legal, procedural, and reputational impossible to ignore. Now we arrive at reputation, the silent, invisible force that runs alongside every transaction, every document, every line in a complaint. Because civil disputes are not only legal matters, they are reputational matters. And in high-profile cases, the two are inseparable. Imagine for a moment being under scrutiny not for a crime in the criminal sense, but for a pattern that calls into question judgment, responsibility, and alignment with expectations. One could argue, technically, everything was authorized. One could argue, factually, charges were made within the rules. Yet the perception of misalignment can linger longer than the resolution itself. Institutions like American Express don't file lawsuits just to recover money. They also preserve institutional credibility. Every action or inaction is a signal. It tells the world, internally and externally, that thresholds exist, that misalignment is monitored, and that standards will be enforced. High-profile accounts amplify that signal. The institution must show not only that it identified issues, but that it treated them consistently, regardless of who is involved. Now, consider the contradiction. From a public perspective, litigation may appear aggressive, even punitive. But procedurally, it is conservative. Filing a lawsuit formalizes the record. It transforms internal concern into something defensible. It allows the institution to say, unequivocally, we acted when thresholds were crossed. That is the logic of risk management. And logic, in this context, is indifferent to narrative. Yet the emotional stakes are undeniable. For the account holder, even the perception of misalignment can ripple far beyond the financial sphere. High-profile individuals operate in an ecosystem where public judgment matters, where image and credibility have quantifiable influence, and where a lawsuit, even if legally routine, can have lasting consequences. This is where timing, pattern, and perception converge. Timing determines whether anomalies occurred before or after scrutiny. Patterns establish whether deviations were isolated or persistent. Perception, fueled by the public visibility of high-profile accounts, magnifies every nuance. Combine these, and you see why institutions act cautiously, deliberately, and with exhaustive documentation. Let's talk about documentation for a moment. Documentation is both shield and sword. For the institution, it is a shield. Evidence of internal review, correspondence, inquiries, and assessments demonstrates procedural diligence. For the account holder, documentation can be a sword. Any oversight, delayed response, or incomplete explanation can be scrutinized to suggest persistent misalignment. The interplay of documentation and timing is where legal and reputational stakes intersect most sharply. High-profile accounts complicate matters further. A routine escalation in a low-profile account may pass unnoticed. In contrast, the same escalation in a widely recognized account triggers external attention, media coverage, and heightened public scrutiny. This is why institutions often double down on procedural rigor with such accounts. Any misstep can be amplified, and any perceived weakness can be interpreted as institutional negligence or favoritism. Here's the emotional tension. The institution is acting logically, methodically, and procedurally, yet the effects on the account holder are deeply personal. Reputation, once affected, is difficult to restore. Litigation may resolve the factual issues, but the public narrative, patterns observed, thresholds crossed, allegations documented, can persist indefinitely. Now, layer in the element of timing again. Not just the timing of charges, but the timing of communications, responses, and internal escalations. Each timestamp creates a chain of evidence. Each response, or failure to respond, adds weight. Courts and regulators interpret these sequences carefully, especially when evaluating whether misalignment persisted despite awareness. Timing becomes more than a detail. It becomes evidence of consistency or deviation, of diligence or neglect. Consider the stakes for both sides. For the institution, credibility and consistency are paramount. For the account holder, the stakes are financial, legal, and reputational. Even minor misalignments, if persistent and well-documented, can become leveraged in ways that dramatically affect perception. And perception in public-facing contexts can be as consequential as legal outcomes. This is also where irony quietly emerges. The very mechanisms designed to protect an institution, documentation, thresholds, compliance escalation, also create the tools that can amplify reputational risk. They ensure the facts are preserved, but in doing so, they make the account holder's actions fully visible and fully traceable. Transparency becomes a double-edged sword. And that's the subtle tension in this case. Nothing overtly scandalous may have occurred, yet the formalization of concern into a lawsuit, combined with the public profile of the account, creates an environment where perception, pattern, and procedure converge to create profound implications. Ask yourself this: if you were in the institution's position, would you allow ambiguity to persist when seven-figure exposure and public attention were involved? Or would you escalate to preserve procedural integrity, even if it meant exposing patterns that in isolation were explainable? That question captures the emotional and procedural tightrope this case occupies. From the outside, actions may seem disproportionate. From the inside, they are the logical outcome of systems designed to manage risk, maintain consistency, and enforce thresholds. Now, here is where we encounter another layer: public narrative versus internal logic. Public narrative thrives on drama, extravagant spending, high-profile personalities, and the implication of wrongdoing. Internal logic thrives on patterns, thresholds, and evidence. The two rarely align perfectly. And when they diverge, the account holder is left navigating not only a legal framework, but a court of public perception. The next tension emerges from this divergence. Even if the account holder's explanations are defensible, the mere existence of the lawsuit, coupled with patterns documented over time, creates a persistent narrative in the public domain. The institution's actions, designed for defensibility, inadvertently fuel speculation. Perception becomes a parallel track to legal reality, and both tracks can influence each other. Finally, consider escalation as both procedural necessity and reputational shield. Litigation formalizes internal concerns. It documents thresholds crossed. It signals to regulators, stakeholders, and other account holders that deviations are monitored and addressed. At the same time, it exposes behavior to external scrutiny, amplifying the impact on reputation. The very act of defending institutional integrity creates a tension between privacy, transparency, and public perception, which leads us to a final uncomfortable reflection for this chapter. The interplay of procedure, timing, pattern, and perception creates stakes that are simultaneously legal and personal, internal and external. Even when every action is defensible, every decision documented, every threshold clear, the narrative, both in court and in public, can feel unrelenting. And that is the quiet escalation that most people never see. The slow accumulation of consequence, not through dramatic acts, but through consistent observation, procedural rigor, and the inexorable logic of institutional risk management.